Welcome back. I will talk about the money market, which focuses on short-term securities that have maturity of less than 1 year. Now, the money market is very important, in particular for financial institutions to organize short-term funding, and it tends to be a market that has lots and lots of liquidity. I just want to point out a few conventions and differences compared to the things we discussed. So first of all, maturities in this segment are less than 1 year. There are two different types. So one is quoted on a yield basis and one is quoted on a discount basis. We already came across the yield basis where we have kind of a coupon rate that then translates into a yield depending on our investment horizon. The discount basis also was covered when we spoke about zero coupon bonds. Then there are differences in terms of day conventions. So in the UK you have the 365 convention. In the US and European market you have 360 day convention, and there are differences in terms of settlement day and so on. So again, whenever you invest in a security like this, you have to look really at the details, because this is important for pricing. Now, one of the biggest part of the market refers to money market deposits, so MMDs. These are fixed interest, fixed term deposits up to 1 year. And the important issue here is they cannot be traded. So you actually don't negotiate after it is issued. So you keep these securities up to maturity. Now, the interest rate is set usually at the London interbank bid rate. So that's the convention in this particular case. It's used quite a lot in financial services. Now, in this particular case, everything, so the interest and the capital, so your par value, is paid at maturity. There's no payment in between. Again, of course, that makes sense because we talk here about short-term securities, so it's not common to have any interest payments in between. Now, in terms of how it is calculated, you have an interest rate, which in this case is denoted R, and you have your principal or your par value denoted M. And then, of course, it depends on the number of days this security is live. That, of course, determines your rate. So this is in this particular equation N. And then it depends on your rate D. So we have a worked example which always makes things an awful lot easier, where we just plug in a few numbers. Now here we have a principal or a par value of 1 million. We have a rate of 9.25%. Now this is annualized. But we only have a 1 month security, so we have 31 days divided by 365 using UK convention, and so this obviously gives you an interest payment of 7,856, and so at the end of the period what you obtain is you obtain your 1 million back plus the interest payment. Yeah. So if you then wish, you can also calculate an effective rate of interest. Now this, of course, would be on an annual basis. There is, of course, one big assumption here, which is a bit hidden in the exponent up there, which actually means you are able to reinvest, of course, now about 12 times with the same rate. Yeah, so this is of course implied in this calculation, because we take this 9.25% rate on 31 days, and then of course we assume, by taking this to the power of 365 divided by 31, that we can use this rate several times over 1 year to achieve the effective rate. Now, of course, that is something you assume. Yeah, so there is obviously a reinvestment risk, because after 31 days, interest rates can change, and most likely will change. So one has to be always careful when it comes to calculating effective rates on an annual basis, because you do make assumptions about how interest rates behave potentially in future. Now, another element of the money market is securities which are also quoted on a yield basis, and these are certificates of deposits. These CDs are negotiated, so there is a market for it. They can be traded on a secondary market, so this makes them more flexible. Again, there is usually a link to LIBIT in this particular case, and maturities tend to be shorter, usually up to 3 months. Yeah, so that's the main difference. And interest again is paid at maturity. Of course, that makes sense given the short period to maturity. And then there are a whole bunch of securities quoted on a discount basis, most importantly, of course, treasury bills. So this is short-term government funding, bills of exchange, bankers' acceptances, and commercial paper. Commercial paper is quite important for short-term funding for large companies, and so these securities tend to be discounted accordingly, and based on the discount, of course, you have an implied interest rate. But this is just a convention. It doesn't really matter. You can always convert between the two. That's just a matter of knowing the convention and applying this accordingly. Now, this is just an example of a discount. So here we have a discount rate, for instance, of 10%. It's a 91-day treasury bill. We have a nominal value of £100. So of course we can calculate a discount just plugging in the numbers as we see below. So this security would be then sold at 97.51, and at the end of the period, so after in this case 3 months, so 91 days, you would get 100 back. And of course then you can calculate a yield from that as well. So that's just important to know as a convention. So this segment, the money market segment, is very vital for short-term liquidity. And of course, in particular in the global financial crisis, this was the market that overnight saw significant turbulences because of a lack of willingness to trade. So you have a significant liquidity risk, which then of course led to severe losses and also liquidity shortages in the banking sector. So that's all for this part. I see you in the next.